When the storm has passed, economists begin their work. In the wake of the crypto winter, the search for explanations unfolded like an inquest, with each theory offering a different lens through which to view the wreckage. None could tell the whole story, but together, they formed a mosaic of causes, part structural, part psychological, part historical. The first camp saw the collapse as inevitable, a textbook example of Minsky's financial instability hypothesis. According to Minsky, prolonged periods of stability breed risk-taking. Speculative borrowing rises, leverage grows, and eventually the system becomes fragile enough to collapse under its own weight. In crypto's case, the cycle moved at digital speed. Displacement in the form of blockchain innovation, boom during the early adoption years, euphoria in the 2020 to 2021 surge, profit-taking by early entrants, and finally, panic. To these economists, the crypto winter was simply another turn of a wheel that has spun for centuries. Another perspective came from monetary economists, who traced the collapse not to crypto itself, but to the sudden tightening of global liquidity. The U.S. Federal Reserve's sharp interest rate hikes in 2022 reversed the flow of cheap capital that had been flooding speculative assets since the pandemic began. In their view, crypto was collateral damage, the first casualty in a wider retreat from risk, much as high-yield debt or emerging market equities often are in tightening cycles. Then came the behavioral economists, for whom the numbers were less important than the human impulses behind them. They saw a perfect storm of cognitive biases, herd behavior, where investors followed price momentum rather than fundamentals. Overconfidence bias, reinforced by the belief that crypto was immune to the laws of traditional finance. Fear of missing out, FOMO, amplified by social media and influencer culture. Once the price momentum reversed, these same forces turned inward. Fear became contagion, and panic selling accelerated the fall. A more structural argument came from institutional economists who pointed to design flaws in the crypto ecosystem itself. They cited the fragility of stablecoins without robust collateral, the opacity of exchange balance sheets, and the absence of a lender of last resort. In traditional finance, bank runs are mitigated by central banks and deposit insurance. In crypto, there was no safety net. Once confidence broke, there was nothing to stop the slide. There were also those who focused on network effects and the fragility of interlinked platforms. Decentralized finance promised resilience, but in practice, the failure of one major actor often cascaded into others because liquidity pools, lending protocols, and collateralized loans were deeply interconnected. This created a domino effect, much like the counterparty failures that amplified the 2008 financial crisis. Yet amid these competing explanations, a philosophical question emerged. Was the collapse a failure of technology or of human behavior? Blockchain itself did not break. Transactions continued to settle. Smart contracts executed as programmed. The code had held. It was trust in exchanges, in projects, in leaders that failed. Keynes's warnings about animal spirits seemed newly relevant. So did Milton Friedman's reminder that markets, left to themselves, do not guarantee stability. Joseph Stiglitz's critiques of deregulation echoed in policy debates about whether crypto markets required more oversight to protect small investors. In the arguments of these economists, the crypto winter became more than a financial episode. It was a test of economic theory in the digital age. Each theory carried its own prescription. Minskyites warned that another boom-bust cycle was inevitable, and that regulation could at best slow its pace. Monetarists emphasize the role of central banks. If cheap money returns, so too will speculative fervor. Behavioral economists called for better investor education, knowing full well that emotion cannot be legislated away. Structural critics urged transparency, robust collateralization, and systemic safeguards before mass adoption could be considered safe. For the retail investors who had lost the most, These debates felt distant, even cold. Theories did not restore savings. Explanations did not erase the memory of watching numbers fall in real time, or the silence that followed when once active communities dissolved. Yet these frameworks offered something else, a way to place personal loss within the wider arc of economic history, to see it not as random misfortune, but as part of a pattern that has repeated in different forms across centuries. Perhaps that is why the search for explanation persisted long after the prices stabilized. Because in the end, to understand a collapse is to reclaim some measure of control over it. And in the long, cold expanse of the crypto winter, control, even the kind that comes only from understanding, was in short supply.